In this episode, we will be talking about technical analysis. Today we will start with the basics, and in our future videos we will share more advanced information so that you have a full understanding of how technical analysis works and how you can use it when trading. A quick reminder, this video is not a financial advice. The information provided is for educational purposes only. My name is Vlad, and on Bunny Money channel you can find weekly videos about finance, investing and crypto. First, let's define technical analysis. It's a method of determining possible price movements by understanding the historical market data. You know what they say? Without knowing your past, you can't know your future. Well, in technical analysis, understanding how the prices fluctuated in the past will allow you to better trade your financial instrument in the present. Unlike fundamental analysis, which relies on evaluation of an asset based on its business results, technical analysis focuses on historical price movements and volume, and both of these approaches are great methods to use when investing and trading. You can't really choose between the two and say one is better than the other, as each type of analysis works better for different people. Besides, it's better to utilize both types of market analysis in order to see the full picture of what's going on the market. Technical analysis has a few methods you can use: chart analysis, data statistics and volumes, support and resistance levels, patterns and trend lines, indicators. There are multiple ways of how a chart can be presented: bars, lines, areas, etc. The most common type, however, is candlesticks. Each candle shows a price movement for a chosen coin within selected time frame. If it's a 15-minute chart, then each candle represents 15 minutes. Each candle consists of two parts, the body and shadows. The body is the difference between the opening and closing prices during those 15 minutes. If it's green, the bottom of the candle shows the opening price and the top the closing price. For a red candle, it's the other way round. The bottom shows the closing price and the top the opening price. Therefore, the green candle indicates increases in prices and the red decrease. In industry-specific terms, bullish is green and bearish is red. Shadow is a line part of the candle that shows the range of prices from lowest to highest within that period. When you are looking at the chart, you are using time frames to represent it. Time frames is a very important aspect of technical analysis. The most common ones are an hourly chart, daily chart, 15-minute chart. There are other types too, and ultimately it's up to you to decide which one to choose. Keep in mind that longer time frames provide you with a bird's view of the market and general trends. So experiment to find the time frame that suits you best. If you are a long-term investor, maybe long-term time frames are for you. And if you are a day trader, those short-term time frames might work for you best. Personally, I use a 4-hour and a 15-minute time frames. The 4-hour one gives me a big picture so that I can anticipate what's going to happen on the market. The 15-minute one determines my trading entry and exit points. I know some good traders who use 1-minute chart for scalping and others who only rely on daily charts. There is no standard. There is no ideal time frame. Use whichever works best for you. Market capitalization is an important aspect to consider in technical analysis, as it gives you an idea of how stable and reliable a coin is. Market capitalization means the total value of the asset that exists on the market. On crypto market, it's calculated by multiplying total number of coins that exist on the market or have been mined by the price of a single coin at any given time. The higher market capitalization, the more stable the coin you are investing in is. So give you an example, cryptocurrency A and cryptocurrency B. A's price is $5 per coin and B's price is $10 per coin. A has 100,000 coins circulating on the market and B 30,000 coins. A's market capitalization is $500,000 and B's market capitalization is $300,000. Even though B's price is twice as high than A's price, the overall value of A is higher than B. Coins with a smaller market capitalization are riskier, but they have the potential to become the future 10 times or 100 times projects. Big market capitalization coins are more stable, but they have lesser possibility of quick and tremendous growth. When you are looking at market capitalization, take into account maximum supply and circulating supply. Maximum supply of a coin shows the maximum amount of coins that will ever exist on the market. The circulating supply shows the amount of coins that are circulating on the market and are in public hands. Trading volume indicates the number of coins traded in a chosen time frame. It can show the direction or a trend for a specific asset as well as predict future price and the demand. It can help you determine whether the trend is legit or not. High trading volumes show a significant trend. If the trading volume is low, it indicates a weak trend. High trading volumes also indicate fairer prices, while low trading volumes show inefficient trades. I rely on trading volumes for finding support and resistance breakthrough. If I see that the trading volume is increasing, it indicates that the movement is going to be stronger. On the other hand, if the trading volume is decreasing, the strength of the trend is weakening and the breakthrough is unlikely to happen. Some people think that the trading volume is the same as liquidity. There is a difference between the two, as volume is the sum of all trades taking place, while the liquidity is the amount available for trading at any single price. This means that the higher the volume of transactions, the more liquid the crypto is. Low trading volumes create differences in prices on different exchanges, which result in arbitrage opportunities. Because of these price differences, some cryptos can be bought on one exchange for lower prices and sold on other exchanges for higher prices. If you would like to understand arbitrage trading better, you can watch our video about crypto arbitrage. Support and resistance levels. Support and resistance levels, also called a buy wall and a sell wall, are very important price levels which have accumulated or are going to accumulate big trading volumes where the price movement will either stop or be reversed. They are support levels made by buyers and sellers, which are depicted as horizontal lines on the chart. The easiest way to find them is to spot places which the price has touched but then bounced off. The support level is at the bottom of a current price. It indicates a strong force that can prevent the price from dropping to a specific level. In other words, a support level is a price point where traders want to buy crypto in high quantities. There, the price is too low and there is high demand. If the price falls lower than the support level, it means there is a breakthrough, and in this case, the support level can become a resistance level. Resistance level means the opposite. It's positioned at the top of the current price and indicates a force strong enough to stop the price from rising higher than this specific level. In other words, there is a significant supply at this price point, but not much demand. At this resistance level, buyers feel that the crypto is overpriced. The majority try to sell before the resistance level, which is why the price can usually bounce off it. However, if the price breaks through the resistance level, this level becomes the next support level. However, variations are possible and we will talk about them in our next video. Indicators are mathematical patterns derived from historical data produced by the price and volume. Some of the well-known ones you may have heard of are Relative Strength Index. Let's talk about Relative Strength Index indicator, or as everyone calls it, RSI. RSI measures the magnitude of the recent price changes with the goal of evaluating overbought or oversold conditions for a specific asset. The RSI is displayed as line graph that moves between the two extremes. RSI can range from 0 to 100. Usually the data before 30 indicates that the asset is undervalued. If it's over 70, the asset is overbought. If the asset is undervalued, you can assume that the price of this asset is going to rise. If it's overbought, the price can drop. If I use this indicator, I would probably place it under the candlestick chart. There is plenty of other popular indicators and we will be discussing them in other videos. In the past, technical analysis was done manually. Now, thanks to technology, computers do all the work. However, as I said earlier, technical analysis really isn't that difficult. And as any approach, it has its own limitations, which is why it's not the answer to all questions, but rather a helpful tool. Experienced traders combine different indicators and methods to confirm the trading signals. But even then, no one can predict anything with 100% certainty. However, the more techniques you know and the more strategies you have, the higher your chances. In this episode, we touched the basic aspects of technical analysis. In another episode, we will talk about patterns, trends, entry and exit points, and other indicators, so make sure you subscribe to the channel for more content. This was our video for today. I'm Vlad. This is your Bunny Money channel. See you in the next episode.